All right, welcome to Iron Financial. This is the place where we help you forge a stronger portfolio and really cut right through all that market weakness. Today, we are putting Workday's latest earnings report directly under the microscope. And look, let's be perfectly clear from the get-go. This is far more than just another quarterly update. No, what we're witnessing right now, this is a critical inflection point. It's a moment that could very well define the next decade for one of the most important enterprise software companies on the entire planet. The numbers they just posted aren't just figures on a spreadsheet. You have to see them for what they really are. They are the opening shots in a massive, massive strategic battle for the future of enterprise AI.
Right, and that is the multi-billion-dollar question, isn't it? It's the question every single investor needs to be asking themselves right now. You can look at their current business, and yeah, you see a giant, you see a profitable company, a fortress that they've spent over a decade building. But you know as well as I do, the market doesn't pay you for yesterday's victories, it only pays for tomorrow's growth. So, here's the real question. Are they actually using all those resources to build a genuine skyscraper, an AI-powered empire that's poised to dominate the next decade? Or is this whole expensive pivot just a new facade on an old building? Is it just a fancy way to distract everyone from slowing growth while their biggest competitors, companies like Oracle and SAP, are already pouring the concrete on their own AI towers?
Exactly. Let's frame this the right way right from the start. You have to think of this earnings report as a referendum. That's what it is. It's the market casting its vote on Workday's huge shift. This pivot away from being a pure software as a service or SaaS company to what they are now calling an enterprise AI platform. For years and years, their story was so simple, so powerful. We're in the cloud, and we're taking market share from the old guard. It worked brilliantly. But now, that story is a whole lot more complex. And frankly, it's a high-stakes gamble. This could either completely redefine their future for the better, or it could become a cautionary tale that the entire industry talks about for years to come.
And let's not forget about the human drama playing out here, because it's huge. You have the legendary founder Aneel Bhusri stepping back into the CEO seat to personally steer this ship through these waters. Now, whenever a founder returns like this, it signals one of two things to Wall Street, and there's really no in between. Either it's a once-in-a-generation opportunity that only they can truly capture, or it's a brewing crisis that only they have the credibility to fix. That move all by itself tells you everything you need to know about the pressure cooker environment inside that company right now. This isn't just about hitting quarterly numbers anymore. For him, this is personal. The stakes are incredibly high.
Okay, so before we get completely swept up in all the AI hype and the big future plans, let's just ground ourselves for a minute. Let's anchor ourselves in the hard, cold facts of the business as it stands today. Because before we can properly judge the risk of their big AI gamble, we absolutely have to measure the strength of their foundation. We need to analyze the concrete and the steel of the operation. And make absolutely no mistake about it, the fortress that they have already built is formidable. It's this fortress that is providing all the financial firepower for this entire strategic pivot.
So let's start at the top line. For fiscal year 2026, Workday is guiding for over $9.5 billion in total revenue. Just let that number sink in for a second. This isn't some speculative startup with a good story and a PowerPoint deck. No, this is a massive global enterprise. To give you some perspective on that, that's more annual revenue than a company like Netflix brings in. This kind of scale, it gives them immense power. It gives them credibility in the marketplace, and it's the very first pillar of that fortress we're talking about. But, as you know, revenue is just one part of the story. This number right here, the free cash flow, this is where the real power lies. Almost $2.8 billion. And remember, this isn't just some accounting profit. This is hard, spendable cash that the business generates after every single expense and every investment has been paid for. So what does that mean for your portfolio? It means the company is sitting on a massive war chest. They can use it to fund their own AI ambitions. They can buy back stock. They can make strategic acquisitions. And they can do it all without taking on a single dollar of debt or diluting shareholders. This cash flow, this is the engine that funds the entire AI blueprint.
And this right here is the bedrock of the entire operation. Over $28 billion in total subscription revenue backlog. Now, what is that? This represents the total value of all the contracts that have already been signed but just haven't been recognized as revenue yet. Think of it as a pipeline of future income that's already locked in and guaranteed. This gives Workday incredible visibility and stability, especially in a volatile market. So while other companies are out there scrambling and chasing their next deal, Workday has a multi-year runway of guaranteed revenue just waiting to be collected. That is the very definition of a durable, high-quality business model.
And this chart, this shows us something really important. The fortress isn't just standing still, it's actively being reinforced. Just look at this momentum. Operating cash flow grew by nearly 20% year over year, and the free cash flow, well, that just surged by almost 27%. This is absolutely crucial. It tells you the business isn't just getting bigger, it is getting more and more efficient at turning every single dollar of revenue into hard cash. It's a powerful cash-generating machine, and that engine is actually accelerating. It's giving them more fuel for the big fight that's coming.
Now, let's peel back another layer of the financial onion and take a look at profitability, because this is where you really see the quality of the core business shining through. On a standard accounting basis, what we call GAAP, the operating margin is a decent 7.5%. It's okay. But when you adjust for non-cash expenses, things like stock-based compensation, you get to the non-GAAP numbers. And the picture here is absolutely stunning. We're talking about a nearly 30% operating margin. This reveals that the underlying business of just selling software subscriptions is fantastically profitable. This is the exact financial profile you'd expect to see from a best-in-class, mature SaaS company.
Okay, hold on a second. Pump the brakes. That's a very compelling picture of the past. The fortress is impressive, I'll give you that. It's a beautiful story about what was. But let me remind you, we're here to make money on the future, right? We're not running a museum here, we're not paid to admire history. And if you actually look closely, if you squint just a little at the forward-looking statements, you'll start to see some very clear cracks starting to appear in that shiny armor. And focusing on historical strength, when the guidance is flashing all these warning signs, that is a classic rookie mistake. The market is a forward-looking machine, and what it sees right now is genuine cause for some serious concern.
This slide right here, this is Exhibit A in the case against Workday. The evidence is just undeniable. The company just wrapped up a year with solid 14.5% subscription revenue growth. That's great. But their own guidance for their own upcoming year is a range of just 12 to 13%. That, my friends, is a material deceleration. In the world of high-growth tech investing, a 200 basis point slowdown is significant. It's a big deal. So you have to ask yourself, are we seeing the very first signs of rust on the walls of that great fortress?
And hey, it's not just me saying this. Wall Street sees it too. This quote says it all. Underwhelming. When professional analysts, who are generally an optimistic bunch, start using language like that, you really need to pay attention. The consensus on the street is that this guidance signals real demand challenges. For a company that trades at a premium valuation, guiding down like this forces every single investor to ask some really hard questions. Like, is that 15+% growth a thing of the past? Is this lower growth rate the new normal for Workday? And this gets to the terrifying central paradox of their entire AI strategy. You see, for a decade, Workday made a fortune with a simple, brilliant model. You charge a subscription fee for every human employee a client manages on your platform. More employees, more money. Simple. But AI agents, well, they're explicitly designed to automate tasks, to make processes more efficient, which could very well reduce the number of human seats a company needs. So are they building a product that is going to cannibalize their own golden goose? It is a massive strategic gamble. They are literally betting that they can create a brand new, even larger revenue stream from AI before they potentially erode their existing one. That is a high-wire act with absolutely no safety net.
Look, the deceleration is undeniable. I'll concede that. But to call it a weakness is to miss the bigger picture entirely. You're framing it as if it's a problem. I see it as a deliberate strategic investment. Management is being completely transparent here. They are telling you why this is happening. They are consciously choosing to sacrifice a few points of near-term growth and margin expansion for a legitimate shot at a once-in-a-generation opportunity. They are just patching a fortress. They are digging the foundation for an entirely new one, the AI blueprint.
And you can hear that ambition coming directly from the founder himself. AI gives us the chance to do it all again. Listen to those words. This is not the language of a CEO who's playing defense or trying to manage a slow decline. No, this is the language of a founder who sees a fundamental paradigm shift on the horizon, a shift as big as the original move from on-premise servers to the cloud, and he is positioning his company to lead it. He is making it unequivocally clear that this is an offensive strategy. This is designed to redefine the entire market.
A vision is one thing. That's great. But execution, that's where the rubber meets the road. And as this slide from Constellation Research clearly shows, the road ahead is absolutely filled with potholes. These are the brutal, real-world questions that this grand vision creates.
Will big enterprises just buy best-in-class AI from some pure-play vendor and then just layer it on top of their existing systems? And maybe most crucially, will this AI innovation actually make money? And will it do it fast enough to offset the slowdown in the core business? That last point is absolutely critical. Are customers hitting the pause button on long-term renewals, just waiting to see how this whole AI story plays out before they commit? These are not small hurdles. These are massive execution risks.
Those are all valid risks, every one of them. But they all ignore Workday's single greatest asset. It's their ultimate unfair advantage in this fight. Over 65% of the Fortune 500 run their businesses on Workday. Now, this isn't just some customer list. It's a map of the global economy's command centers. Workday's software is already the central nervous system for the most critical operations inside the world's most important companies. They don't have to go knocking on the door to sell a new AI product. Why? Because they are already inside the building, sitting on top of the most valuable proprietary data imaginable. The trust they have spent over a decade building, that is their Trojan horse for AI.
And let's be crystal clear about what inside the building really means. Their platform is the system of record, the single source of truth for a company's two most precious assets, its people and its money, human capital management and financials. By unifying all of this data onto a single platform, they can provide insights that no competitor can easily replicate. And this isn't just some minor advantage, it is the entire foundation of their AI strategy. Because as we all know, any AI is only as good as the data it's trained on. And Workday is sitting on a proprietary goldmine of people and money data.
But they are admitting the trade-off right here, in their own words. Prioritizing investment, that's just corporate speak for we're spending a ton of cash. And that spending comes at a cost to shareholders, at least in the short term. The CFO was very explicit about this. He said margin expansion will slow down. So the deal they're offering to investors is pretty clear. Accept lower growth and accept lower margins today. And for what? For a promise of a payoff that is years away and is far, far from guaranteed in what is becoming a hyper-competitive AI landscape.
And that brings us right to it, the final verdict. We've laid out both sides of the coin, and we've used the hard numbers to back them up. On one side, you have the solid, cash-gushing reality of the existing business. That's the fortress. And on the other side, you have this ambitious, high-risk, but potentially revolutionary AI blueprint. So it's time to weigh the evidence and really understand what an investment in Workday stock truly represents for your portfolio right now. Okay, so let's break it down. The fortress case, the bull case, is built on that massive $28 billion backlog, the incredible free cash flow, and its deeply, deeply entrenched position inside the world's biggest companies. It is a high-quality, wildly profitable business. But as we've already established, its days of 20% hypergrowth are likely in the past. Now, the blueprint, the bear case, the risk here is that the core business slowdown is permanent and that this whole AI strategy turns out to be a costly, high-risk venture that just fails to deliver. If you invest now, you are betting on their ability to flawlessly execute a massive technological and business model transformation against some very intense competition.
And that really is the bottom line. The most crucial point for your portfolio is this. If you buy Workday stock today, you are not buying the company we analyzed in the first half of this explainer. You're just not. The stable, 15+% growth, margin-expanding SaaS compounder that everyone loved, that investment thesis is now officially in the rearview mirror. An investment today is effectively a venture-stage bet on a completely new company, a company that's going to be built on Agentic AI that frankly doesn't fully exist yet. You're not buying the fortress anymore. You're betting on the blueprint.
Here at Iron Financial, our job is to give you the unvarnished facts so you can make smarter decisions. You've seen the strength of the foundation, and you've seen the ambitious design of the tower they want to build. You now understand the trade-offs, proven profitability versus high-risk, high-reward growth. So the final question, the one we leave you with, is this. When you look at your own portfolio, your own strategy, are you looking to own the proven, cash-generating fortress, even as its growth begins to slow? Or are you willing to bet on the blueprint for the unbuilt skyscraper? The choice, as always, is yours.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.